Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. My guest today on the show is Prashant Khemka of WhiteOak Capital. Prashant, good to see you on the show again. I want to start by asking you about the global situation because the world was beginning to relax a little bit over the last fag end of the last year. Everybody thought that the Fed was nearly done with rate hikes and maybe there will be a pivot point at some point during the year. But now, after the data of the last week, everybody is reflecting once again on whether it is indeed the case or whether inflation continues to linger and the Fed will remain or keep rates higher for longer. And that seems to be a kind of reassessment which is going on globally. How do you read that situation, the recent data, and the risks that it might pose for the market?
Certainly, Udayan. First of all, thank you for having me here again on your show. So you're right. Last few days, first of all, if you see year to date, the markets have had globally a good start. U.S. Markets, if you see, Nasdaq is up double digits, some 12% or so. S&P is up more than 5%. So yes, it is continuing, I think, to believe that we are towards the fag end of Fed hikes and the inflation problem. But the very recent data points, as you alluded last week or two, what they are suggesting is the economy is much stronger than what the market was anticipating. A lot of macro experts or gurus were expecting. Now, generally speaking, economy is stronger is good for the market, but the here this time around the situation is that people are hoping that a somewhat softer economy is what the Fed is desirous of, because a softer economy would mean further reduction in inflationary pressures at a quicker pace. So it's a mixed one, I would say, Udayan. On one hand, what it is suggesting is that the economy is not falling off as rapidly despite the hikes in interest rates over the last 12 months or so. Inflation, all said and done, has been coming down. Yes, it's not come down as rapidly in the last couple of data points, let's say, as we would like to see it come down. But can we? It also brings the interesting question that can we achieve a reduction in inflation without really, throwing the economy into doldrums? So maybe it takes a little longer for inflation to be tamed to its to its levels that are, let's say, 2%, or whatever is the target range of around 2% that the Fed talks about. Can it be brought to that, even if it is on a longer trajectory, but without throwing the economy under the bus? So I think it is a mixed data points over the last few days. I won't read it as completely negative. To me, the strength of economy is a positive.
Now, only to the extent of what it means for global flows into India. I know the markets held up last year because of domestic flows, but foreign flows are also important in their own way. But, last year was not very good in terms of FII flows. If interest rates in the US are to continue to rise or remain high for much longer, what does it portend for 2023 in terms of FII inflows?
Now, again, I think there'll be both sides, Udayan, the growth aspect as well as the interest rate aspects. Hard to just look in isolation the interest rates as a factor. You would recollect very well during 2003 to 2007, in the midst of rising Fed rates, the flows were still very strong because the economies all around the emerging markets were booming. So I think there is still possibility that interest rates remain, and we have to remember the data points aren't like a reversal or a major reversal. We are talking about, interest rates peaking instead of 5.25 to maybe 5.25, 5.5, or thereabouts. It's maybe a somewhat higher, not a dramatically higher regime that we're talking about. If for some reason inflation were to have a revival to higher levels, and then that means a substantially higher interest rate regime than what is can be considered within a ballpark of where we are today, and then that forces a much sharper slowdown down the road for the global economy and the EM economies. That could be a negative scenario. But if it is, we're talking about, modestly higher interest rates, but an overall stronger economy, without doing as much damage to the economy as was afraid last year, as was feared last year, then net then might not be that negative for EM flows. And India being, as you know,
Okay.
nearly
Speaking of
80% of Indian flows are a
yeah,
function
please go ahead.
of EM flows. So if EM flows are to turn south as they were last year, then India can't be, aloof to that. Uh, so that remains to be seen on how EM overall does in terms of flows.
Right. Speaking of flows, Prashant, how did the whole Adani episode over the last few weeks shift the mood towards India, if at all? I mean, do you think it has done anything to color the judgment of global investors that you may be speaking of all the time? Were they rattled? Were they shaken by this episode?
To some degree, there were heightened inquiries, Udayan, and we fielded a lot of questions as well on the from our global investors on implications. We had, client calls and webinars and whatnot. So there were a lot of questions, and there were worries of spillover, contagion risk. Can it, bring down the Indian markets? Was one of the concerns. But I think as Indian markets have held up quite well, by and large, and the broader EM has pulled back during this time as well, and Indian market hasn't necessarily even underperformed over the last 3 weeks or so. I don't know the precise numbers, but just thinking through my head, I think Indian market might even have outperformed at least month to date by small amounts, but it is very different from what was feared about, underperforming quite substantially. I think those fears have receded, Udayan. Now hardly anyone is asking about, the contagion effect of the developments on broader Indian markets.
That contagion actually was feared, Prashant, largely on the lenders to the Adani group, many of which were actually public sector banks. You've always been a big supporter and owner of the private sector financials. When this episode happened, did you feel vindicated that you were not such a big owner of the public sector financial space and you've always restricted yourself more or less to private sector financials?
So, great question again, Udin. I want to be mindful of what I say. I would say, look, in this case, I think from what the comments and statements that have come out from across the banking sector, I think there's the exposures are nothing out of the ordinary, and the reason to own more private sector over time, and we continue to as a team, like several of the private sector banks, is that the alpha opportunity that we find there is a lot more compelling than at public sector banks. Though those public sector banks have also done very well over the last couple of years. So vindicated might be a strong word, but yes, we continue to like, for a variety of reasons, private sector banks.
When you say private sector, is it the trinity of the big ones with ICICI, HDFC and Kotak, or have you gone down the ladder and looked at some of the smaller private sector names?
So I'll say more broadly, well-run private sector financials, and there are some non-banking financials as well. Obviously, Udayan, as you know, I can't speak about individual names, but we have in our portfolio several non-banking financial companies as well. The idea is that, in banking, you have to have strong liability franchise. With some of the larger banks that you're talking about, they have very strong liability franchise that contains your cost of funds. If your cost of funds are low, you can afford to be picky about the asset side of the balance sheet, and you can pick the right risks if you're doing your job well, executing well. And even with a lower yield on assets, you can generate more than adequate profitability once you have a strong liability franchise. In case of NBFCs, the liability side is not as big a differentiator, but if you develop a strong niche in certain asset category, as several of these strong NBFCs have done over the decades, they've developed mastery in a particular asset class or more than one asset class, be it in consumer durables, be it in automobiles, be it in gold loans. I'm not saying we own each one of these, but there are different NBFCs who've developed strong execution expertise in these niche areas. They can, if even if their cost of fund is in line with other NBFCs, they can generate outsized returns for a long time to come.
But the one wrinkle in the financial space, in the non-banking space, has been insurance, Prashant, more so after the union budget. I mean, if there's one sector which got hammered after the budget, it was insurance.
Yes.
Did you own a lot of insurance stocks in your portfolio, and have you had a revisit or a rethink after the provisions of this budget on that space?
Certainly, we have evaluated this as a risk at all times because, this risk was out there. Obviously, it materialized in this budget. Some of that has materialized in this budget. So the insurance exposure in the portfolio wasn't that substantial, but certainly there was some exposure to insurance. And whenever some such thing happens, you have to reevaluate the position in either direction. Regardless of even if you don't own, you would reevaluate. And yes, the team did reevaluate the thinking on the insurance companies. And it is a negative, there no doubt.
Okay.
I mean, for
So
insurance
you're no
companies,
longer as optimistic as you used to be.
that would be fair to say. At least in the near to medium term, there would be some adjustment, there would be some rebasing, and we would then know what is the real volume of demand that wasn't driven by these tax benefits. So there would be some reset. How big that reset is yet to be seen.
Okay. The other space you've been consistently optimistic on has been consumption, discretionary consumption. Which parts of it are looking attractive to you now? Because, autos have begun the year quite well. I mean, we've seen some, even from a stock perspective, stocks like Tata Motors have done very well. The numbers are encouraging from the likes of Bajaj Auto, Maruti as well. Have you had reason to up your weightage or look at the auto space or consumption and consumer discretionary in a more positive light?
No, very true, Dan. I think besides financial services, I would say consumption is a area, and the third one would possibly be IT services, where the team always finds a great number of companies to pick and choose from. It's more the fact, Dan, that there's such a large number of and a variety of business models in this space. Very well run, entrepreneurially run. Yeah, consumer discretionary, as you can agree, has large number of mid cap, small caps, and some large cap names as well, which are very well run and governed. It's not a space that attracts governments anywhere in the world in competition, if you will. So there are a lot of names, a lot of ideas to pick and choose from, and great ideas, alpha generating ideas, and hence the team has always had that. To your specific question, even now we do have ideas in consumer discretionary, including some of the auto names which we've held for quite some time now, and obviously all auto names have done quite respectably this year. We have names in let's say, without being very specific, jewelry segment. That's a segment where besides demand year after year, what you see is a very long pathway for organized sector to continue to take market share from unorganized sector. Even after 20 years, 30 years of that journey, we are still at very early stages of that. And it's there are many other segments like jewelry, where the discretionary, the companies in the discretionary organized space are actually leading the shift from unorganized to organized. And we have such investments across several industries. I just mentioned jewelry as one example. But it's in apparels,
Taking
it's
off
in
from autos,
apparels and
Prashant, I want your thoughts on the aviation space, because that there it seems like competitive forces are picking up with the entrance of the Tatas in a much bigger way. I mean, their recent airline order has really stirred people up in that sector. Do you think there is money to be made in the listed space in aviation?
Certainly. So, Udayan, it's one of those spaces where I've hardly ever invested, whether in India or even earlier when I was investing in US or developing or emerging markets overall. Because what I find is the competitive dynamics are ever evolving in this. It's very difficult to, like 5 years ago, it was impossible to predict the current structure of Indian aviation market would look like what it is looking right now. Some of the large players from 5 to 10 years ago are no longer existent. Some of the players who were non-existent 5 to 10 years ago are today major players or on the way to becoming major players. It's a sector which has a lot of regulatory involvement as well, and just there is no stability or predictability. I would say analyzability, if that were a word, to the competitive landscape going forward, as there is in other areas that we talked about: auto, be it jewelry, be it apparel, footwear, and all those spaces. You can apply your head and apply logic and have some forecast to hang your hat on. You will still go wrong, but at least you can work with some conviction in your in the logic that you follow in those other cases. In aviation, I find it extremely difficult.
What's happening with pharmaceuticals, Prashant? That's a space which has disappointed investors big time. I mean, whether you look at a DV's Labs, I mean, the way the stock has come off, Cipla more recently, before that Sun Pharma. This is a space, Lupin. The large caps have disappointed investors over the last many years. Do you see any silver lining on the horizon here?
No, very true, Udayan. Over the last, after the meteoric rise that pharma sector had, possibly from 2008, 9 times, some such time frame till 2015, 16. After that, they've gone nowhere but down. The largest of names have disappointed mid caps across the market cap spectrum, uh, and more regulated market exposed you are, the more has been your uh, cup of troubles, if you will. Uh, what we do like, though, are more domestic focused franchises, uh, businesses that cater to the Indian demand much more so than regulated markets like US or Europe. Now, most of these companies do have some US, Europe, but it's the proportions that matter. If vast majority of your business is US, Europe, and other regulated markets, that's more of a business that is continually under competitive pricing pressures, as well as some of the regulatory issues. So we look for companies who are by and large more tilted, heavily tilted towards the domestic market, or there are some companies who are focused more on emerging markets, not as much on the regulated market. So those emerging markets, like say Africa or Asia Pac, and so on, they are markets more similar to the Indian market. So that is one segment of the pharma market that's interesting. And I know you mentioned about pharma, but then if you were to cast the net a little wider to more healthcare, then there are obviously hospitals and diagnostics, and as well as the CDMOs that are there as a investment opportunity, and some great ideas from there as well.
Great hearing your thoughts, and thank you very much for your time today.
My pleasure. Thank you, dear.
If you like the video, do like, comment, share and subscribe.